Hello, everyone. My name is Logan Holloway, and I'm doing my case 2 on the Chapter 10 case, A Job at East Coast Yachts. Some background information about this case is that I'm a recent college graduate. I got a job offer from the company, the East Coast Yachts, and they informed me about a possible 401k retirement plan, and they explained the many options for the retirement investments. And it's my job to decide which options are best for me. So the first option is a Bledsoe S&P 500 index fund. This is a mutual fund. It's basically a pool of many investments from different industries. It's funded by a lot of different investors. It's professionally managed. It has a low expenses, low expense ratio. It's very diverse. It's a low risk, moderate reward stock, and this is typically best for long-term investment. So just as a college graduate, would probably be a strong contender, I would think. The second one they told us about is the company stock. This is a singular stock in our company, the East Coast Yachts. It's not a collection of stock like the other ones will be on this list, but it's just our company stock. It is a private stock, but they do expect it to go public in 3 to 4 years. It's not diverse. It's a high risk, high rewards type of stock. It has individual stocks tend to have a higher expense ratio, but this is definitely something to think about, especially because it's not public. Not everybody has access to this stock, but you probably wouldn't want this to be your entire portfolio. The fourth one we'll look at is the Bledsoe Small Cap Fund, this is just a collection of small cap stocks. It's more volatile than the mutual fund, but it's less volatile than having an individual stock like the one in our company. I would say so. This has an expense ratio of 1.7%, which is on the higher end of what we see today. So this may not be something that I would particularly look at, but if you want to invest in smaller businesses, then this would be the one for you. Albeit, this does carry the risk of those businesses going under, which is more common, especially compared to large cap businesses. This is a risky venture. However, it could be rewarding. And then, if we're going to talk about small cap funds, we need to talk about the large cap. This one has a slightly lower expense ratio, 1.5%, which is still on the higher end of what we see today. It's less diverse than the index fund we viewed earlier, but it does have potentially higher returns along with a higher risk. However, it is also easy to access these funds, so this may be a short-term investment, maybe for a year or less, even to put a smaller percentage of the portfolio into something like this, into some large companies that maybe aren't as risky as some of those small cap businesses. But again, this probably wouldn't be something to put the entire 401k into. And then we have the money market fund. This is the safest, lowest risk option. However, you won't make any money back if you just keep everything in the money market for the whole time. The money market fund is at a risk for inflation if it can't keep up with the dollar. However, it is the safest option, but it's basically, you might as well put your money in the bank at this point if that's all you're going to do. It is super easy to access your funds in the money market account, and to really take advantage of the money market, you wouldn't want to keep all of your money into it. You would want to put into something else and then have a reserve in the money market. That way, if you see a gap in the market or you think you can take advantage of it, then you can move the money you have in the money market to something else. So now we're going to look at what situation is right for each investment option. Not all of these investments are the best for everybody. It depends what you're looking for in your portfolio, and that will depend which options you go for. Firstly, the company stock, like we talked about earlier, it has potentially higher earnings in less time than the other ones, and it may be better for people who maybe have less time before retirement, or if they're super optimistic in this company, or really any company, if you're going in it for just one company. If you're really, if you think they're gonna boom, or you just don't have time, if you start investing later in life, or maybe if you wanna have more risk, then the company stock would be for you. But I wouldn't recommend putting your entire portfolio in just one company, or maybe just a collection of just single company stocks. The second one is the S&P 500 index fund. This one has a lower risk, but with lower fees, and it has a moderate growth over time. You'd want to try matching the market, and this one specifically would be following the S&P 500. This is a good choice, especially for a stable portfolio, and is great for younger investors to have growth over a long period of time. This is shown to have a lot of success over the last few decades, and this is probably, being a recent graduate, going to be the bulk of your portfolio. The small cap fund is riskier than the large cap stocks and riskier than the index fund, but it does have high growth potential. This could be something that you put a portion of your portfolio into if you're interested in investing in small cap stocks. The large cap stock, on the other hand, is similar to the small cap fund, albeit the companies are bigger, more successful, safer, in my opinion. It does have a lower growth, but you can make dividends from these funds, and it's valuable for diversifying your portfolio. And you probably wouldn't want to put your entire portfolio into a large cap fund either. And then the money market fund is, like I said before, it's the safest option, although it has minimal growth. It's the best if you predict the market's going to fail or go down. Then you can move your money out of the money market account into another fund like the S&P, or even just company stocks. If you see a company go way down and you predict it's going to go back up to where it was, then you can move a lot of your assets out of the money market into that and take advantage of the dip. That's how you leverage the money market. And then the last one we'll look at is the bond market. Now, bonds are a safe and stable option, and they're legally protected by the government, but it's very hard to access your money. Well, you can access it, but you will most likely have to pay a lot of fees, and it's really only viable for long-term investors. So my conclusion from this case is that the two most important aspects of this 401k are going to be growth over time and diversification. So what I would want to do as a recent graduate is 70% of my portfolio is going to be in the 500 index fund. This is a very safe option with growth over time. This will be the one that you keep pumping into for 20, 30 years until retirement. 15% I'll go ahead and put into the company stock. It depends how this company is, but I would say that if I'm really optimistic about it, I would continuously put 15% into that until it goes public. When it goes public, if it is succeeding like I would think, then it would shoot up. Maybe then I pull it out and put it into something else. 10% I would want to go into a large cap fund. This 10% is something maybe you can mess around with. Take it out, put it into different funds, mess around with a little bit. And then 5% I would just dump straight into the money market account, just so that you have a little bit of flexibility if the economy starts to go down, or if maybe your investments start going down, then you can put more in for when it goes back up. So that gives you a little bit of flexibility, so you can play the market a little bit.